Hello and welcome to another episode of the Mark Moss Show, where we talk about the decentralized revolution. Of course, we talk about the way the world is changing right before our very eyes. As I say, the world we're going into is not the same as the one that we're leaving behind. And we like to look at it through the lens of course, politics, finance, and technology. And the technology that is changing the world is, of course, Bitcoin and the decentralized technology. And, I like to bring to you some different ways to look at the world. I try to expand your thinking so you can really understand these complex subjects that we're dealing with, some of the latest breaking news, and some interesting people to listen to as well. So you don't have to hear me talk all the time. But today I want to start off talking about something that's basically dominating most conversations today. And I want to explain it to you in a way that you probably haven't yet heard. And so we're going to talk about this because this is actually what's changing the world. And it's really all about the money. So we said I talk about it from politics, finance, and technology, and really this financial piece. On about an 80-year time frame, we have these financial revolutions, and that's exactly what we're facing right now. We can see we're at the end of a long-term debt credit cycle, potentially a 100-year sovereign debt bubble that's blowing up. And of course, you see all over the news, everything, you see inflation, and you see debt ceiling limits increase, and money being printed and sent around the world to people, etc. And it's hard to really understand what's going on, especially when you have some intellectual mouthpieces like Paul Krugman talking about this and trying to explain to you, but it's all wrong. Now, if you watch my main YouTube channel, just the Mark Moss YouTube channel, I like to start off the videos by saying I'm trying to change the way you think about money because almost everything you've learned is wrong. And when you listen to people like Paul Krugman, they're lying to you. So, of course, everything you've learned is wrong because they're telling you the wrong information. We're going to talk about that specifically, but also what we learn in school is wrong. They don't teach you about the way money works. They don't teach you about the way the financial system works or the banking system works. And of course, they don't tell you how to get wealthy. They tell you how to basically live within this system without disrupting it, without changing the way the system works, and without really getting ahead, which is why, of course, today, about half of all people retiring today, the baby boomers, are broke. They have no money. About half of the people today couldn't come up with $1,000 for an emergency. And so, how's that financial education you've been getting working for you? If half the people retiring have no money, and of the people that do, of the half that do, half of them have less than $100,000, which is not enough to retire off of. So how's that financial education been working? I saw, I think 50 or 60% of people making over $100,000 per year, which most of you might consider that being rich or well off or something like that. About half of those people report living paycheck to paycheck. So how's that financial education coming for you? It's obviously not working very well. I talked about it on the radio last week in Baltimore and then in Chicago. In Baltimore, it was more about reading. In Chicago, 55 school districts, not one single student, not one, could pass math or reading. So how's that education going for you? So let's talk about this a little bit, and let's explain what's going on. Now, the Treasury, which is the United States government, so we have the Federal Reserve, and we have the Treasury. The Treasury is the United States government. The Federal Reserve is a bank. It's a collection of banks, and it's a private bank. Now, for some of you listening to this, you doubt that. It was set up as a private group of banks. It is recognized and allowed by Congress. So it's quasi-private, if you will. It's really private. It does maintain its autonomy. And they control monetary policy, so they control the banks. The United States government and the Treasury control the fiscal. All right, so that's the money being spent in the government. The Fed just controls the monetary policy, which is interest rates and the amount of the bank's reserves, et cetera. So the United States government, the Treasury, put out a report this last week. It's called the Financial Report of the United States Government Fiscal Year 2022. It's at fiscal.treasury.gov if you want to go read this report. Now, it's 258 pages, so you probably don't want to read all of that, but it's worth a read. So this is directly from the Treasury. This is their own report. And it starts out on the first page with a letter written by Janet Yellen, which, of course, is the head. She's the Secretary of the Treasury, the Department of the Treasury, which, of course, is the United States government. And basically, in this document, surprising that they would actually put this document out. Because in this document, they basically make the case that the government is bankrupt, insolvent, what we'd call a zombie company, and they make the statement that says the path that we're on is not sustainable. That's what it says. So it's pretty interesting that they would put out this information. Now, like I said, everything you've learned is wrong. So typically they're trying to change the story, change the narrative, show you information that maybe misleads you. But in this information, they've basically come out and told you, and like I said, even made the statement that it's not a sustainable path. All right, so we're going to go, what I like to do is go directly to the source. I want to see the source of the information. I want to see what they have to say first before I start listening to other people's opinions of that data. Now, back to Paul Krugman. Paul Krugman is, like I said, kind of the mouthpiece of the Fed, the Treasury. He's the cheerleader that basically says everything they do is correct. And of course, Paul Krugman is not correct. He's never been correct. Paul Krugman is the one who famously said, what did he say? I want to get this one right. He said that the internet would fade. It would never grow anything big. What did he say? Oh, the internet's impact on the economy has been no greater than the fax machines. That's what he said. The internet's impact on the economy has been no greater than the fax machines. 10 years from now, the phrase, quote, information economy will sound silly. So look, when we have economists, when we have forecasters, when they give us their information, we should take that and pay attention to it. And then we should of course, see if that information comes true. So if this is somebody we want to continue to listen to. So, for example, when Al Gore has been going around the world telling us that, I think it was by 1989, the polar bears would be extinct. He said that the ice caps would be gone by the summer of 2013. In 2009, let's see what he said here. I didn't look this up, but I don't want to get this wrong. Al Gore said in 2009 that the North Pole will be ice-free by the summer of 2013 because of man-made global warming. The polar bears would be gone by 2013. So he said this in 2009. Here we are a decade later, and the ice caps are even bigger than they were before. Polar bears are flourishing more than they ever have. So Al Gore is someone we should not be listening to in regards to climate. And back to Paul Krugman telling us about the economy, it's the exact same thing. He said that the internet's impact on the economy has been no greater than the fax machine, and that 10 years from now, the information economy would sound silly, but yet here we are in the information economy. I make my living in the information economy. You're listening to me right now making my living in the information economy. And of course, that doesn't sound silly. And so again, is Paul Krugman someone we should be listening to? And I would say absolutely not. But of course, the government needs someone to be out there shilling their data points. And that's exactly what Paul Krugman does. Now, there's an article that came out this week that I thought was pretty interesting. And of course, he's a Nobel Prize winning economist. But he recently wrote some articles in the New York Times, which, of course, the New York Times is also a mouthpiece for the government. It's important to listen to the information and know where it came from, what their interests are, what their biases might be. And then you have to start to learn to separate the facts from opinion. And so we know that, for example, if I was reading RT Times, I would know, well, that's a Russian news outlet, and it's probably biased towards Russia. If I listen to the New York Times or the Washington Post, well, I know that's like a CIA mouthpiece, and I have to know that it's biased from that. Potentially, at this point, maybe some of the most neutral news might be Al Jazeera. I like to get some news from there. I try to look at it from both sides. So I'm going to be equally critical of both sides that are trying to spin this bias, but still fact check me as well and start to try to separate what I tell you as fact from what I tell you as opinion so you can start to formulate your own ideas. Anyway, so he wrote this in the New York Times, and he claimed that the debt of the government is, quote, overhyped issue and isn't all that unusual from a historical perspective. Now, this article that came out said that his attempts to support these employ the kind of fraudulent accounting that would land a corporate executive in jail. So what he's doing is he's taking this data and trying to spin it to support his point, but it's so much of a speculation, it's so much of a spin that it would literally land a corporate executive in prison if they tried to do this. He says that, of course, he's trying to say that taming, quote, the federal debt should be well down on the list of government priorities. So he's saying that it's not a problem. The debt's not a problem. We shouldn't even be worried about it. As a matter of fact, it should be way down the list of all the things that we're worried about after we worry about things like climate change and child poverty. Because the debt projections have become, quote, much less dire over the past decade or so. In reality, the debt is far higher than projected, and Krugman's own words prove it. Now, I'm going to talk, let's dig in. Let's see what these numbers are. I'm going to give you the numbers directly from the Treasury's own report, not from Paul Krugman and not opinion-based. We're going to look at what the Treasury put out. Now, I do want to just say, going back to Paul Krugman, in 2009, under President Obama, they started racking up debt, and they projected $9 trillion in deficits over the coming decade. So that'd be from 2009 to 2019. Krugman wrote back then, quote, even if we do run these deficits, federal debt would be 90% of GDP in 2019, or substantially less than it was at the end of World War II. So again, the Nobel Prize winning economist is telling us that, no problem running these deficits. Even if we do run a $9 trillion in deficits, it's going to be way less than it would in World War II. However, he said it would be 90%. However, it turned out to be 21% higher than that, 110%. So again, he's wrong. I don't know why we continue to look at him or listen to him, but let's take a look at some of these things that the Treasury put out in their own data. Now, what we can see is that the U.S. has a massive spending problem. So if we go back, unfortunately, I can't show you the chart because we're here on the radio, but if I showed you a chart, you can go onto the Fed. So the Fed puts out its own data, and you can go to fred.stlouisfed.org, and you can get all this data that the Fed actually puts out. I like to go to the source. And so if we look at this, we can see basically a chart of lines which shows the debt, the amount of debt that we're building, and the amount of gross domestic product that we're producing. So remember, wealth is not money. Wealth is goods and services. So we want to look at the gross domestic product, the amount of goods and services that are being produced. Now, it's a little bit of a misleading number because the amount of spending the government actually does that, increases the GDP, has grown bigger and bigger and bigger. But that's a whole nother topic for another time. But if we look at just the GDP growth, we can see that until about 1970, the GDP growth and debt were growing at about the same pace. But since around 1970, they really started getting off. Really, 1980 is where they just really took a drastic turn. And we can see that now the amount of debt we're growing is way outpacing the amount of growth. Now, the problem with this is that means it's not sustainable. Now, the scam is that they tell us that, hey, we took an economic hit. We're not going to get as much growth as we normally would because of whatever recession or whatever the pandemic or whatever it is. And so we should just take on a little bit of debt. Let's go ahead and spend more than we bring in because we'll make it up later. It's sort of like if you lost your job and you're going to live on a credit card for a little while, but it's okay because when you get another job, then you're going to go ahead and pay that debt back off. Or you're going to go into debt to build a new product or business line or a new business, and then when the business grows, you're able to pay that off. The problem is that the business doesn't ever take off, it doesn't grow, but yet you keep spending more and more and more and more debt, and eventually it's going to hit, But the problem is all that debt bogs you down and doesn't allow you to grow. All the money that should be going into productive investments gets spent just to cover the debt, or what we call the interest coverage. Now, you might have heard the term of a zombie company before. We have lots of zombie companies in the U.S. and around the world. And a zombie company would basically be a company that doesn't make enough money, enough profit to cover even the interest on their debt. That's a zombie company. So no matter how much they grow, they just can't pay off the debt because just to cover the debt, the interest is more than the money they make. Now, could the government be in that position? Could the United States government be a zombie company? Revenues must cover expenses plus interest, or you're a zombie. Now, the U.S. government has a problem, and that is that their entitlement spending, which is the mandatory, this is money they owe to people, Medicare, Medicaid, Social Security, et cetera. They have to pay this, mandatory expenses. So just that alone, not all the other expenses, just that plus the interest on the debt is more than the tax revenues they bring in. That means they're a zombie company. Now, that doesn't take into consideration all the other long-term contracts they're committed to, like defense contracts, but let's go ahead and skip past that. So just per the Treasury, the CBO, Congressional Budget Office, this is the government, estimates that for this year, 2023, there will be $4.8 trillion in tax revenue, but the mandatory expenses, which are the entitlements, also the defense budget, $800 billion for defense, and $700 billion, which is the net interest on federal debt, equals $5.3 trillion. So you don't have to be super good at math. $5.3 trillion of mandatory expenses is more than the $4.8 trillion of income. So that's a zombie company. Now, that doesn't include all the other spending. Well, I'm not talking about, all the other money that we're sending to Ukraine and all the other money we're sending to other countries for, gender studies. I'm not counting all the money for welfare and UBI. I'm not talking about any of that. I'm just talking about the mandatory, the entitlements, the money we owe to other people, Medicare, Medicaid, Social Security. I'm talking about the defense, and I'm talking about the interest on the debt. That's it. Now, you also know that the Fed is on a warpath to fight inflation. They are raising rates higher to fight inflation. But there's a couple of problems that really lead to the zombie company really going overboard. And so as the Fed continues to raise interest rates, the net interest on the debt goes up. So per the CBO, Congressional Budget Office estimates for this year, they estimated $700 billion in interest on the federal debt. However, you keep hearing about, the economy is still pretty good, the jobs market is still pretty good, the Fed's going to keep hiking rates. Now they're talking about the Fed getting to potentially a 6% rate. 6%. What does that mean? Well, that means at 6%, the interest of the government is now not $700 billion, it's about $1.8 trillion. $1.8 trillion. Now that's on the $31.5 trillion of debt we have today. That's not including where it might be by the end of the year. So that's not $700 billion, it's $1.8 trillion. That's an extra $1 trillion. An extra $1 trillion a year. Now, the CBO, Congressional Budget Office, again, they have these projections where they show, just like any business would, what their revenues are expected to be moving forward, 2024, 25, 26, 27, all the way till 2033. So they show the revenues, how much they expect to get from income taxes, payroll taxes, et cetera. And then they show their outlays. And they break it down by mandatory, what's the mandatory expense they have to spend, and then what's discretionary. So mandatory for you personally would be like your house payment, your electricity bill, your car payment. You have to pay those things or you get put on the street and you have no car. Discretionary would be like, going clothes shopping, going out to dinner, things like that, going on vacation. So you have the mandatory and discretionary, they break that out, and then they show the total deficit, so the shortcoming. So in 2023, they're showing a deficit of $1.4 trillion. By the end of the decade, they're showing it to have by 2030, have a deficit of $2.1 trillion. So basically, adding in $2 trillion of debt every single year. $2 trillion of debt every single year. Now, this is first of all, this is based off of tax revenues staying the same, which they're not. As a matter of fact, tax revenues are down 9% year over year. Why are tax revenues down? Well, it turns out the Fed is on a warpath. The Fed is on a warpath to stop inflation. They want prices to stop going up. They want prices to stay stable. They don't really want prices to come back down, but they want prices to stop going up. So what they're doing is they're crushing demand. If we raise rates higher, that will bring asset prices down, your stocks, bonds, your retirement account. That will bring your real estate, your house value down. And if we can bring the value of your assets down, people feel broke and they don't spend as much. That's their theory. The problem with that is that as asset prices come down, then there's no capital gains. Like I'm not selling stocks or real estate at a profit. So there's no capital gains tax going to the government. So now tax revenues went down. Also, they want people to feel broke so they stop spending. But if people stop spending, then the tax revenue drops. So the CBO has this baseline projection, but they're basing it off of tax revenues going up. But in reality, tax revenues are coming down. They're down 9% year over year. Now, if we have a recession, which it looks like we're going into, I'm going to talk about some of the data here in a minute. If we have a recession, then we would expect tax revenues to dip by 20%. So now what does this do to the qualifications, the calculations? So you can see we're in a really, really big problem. Now, the CBO, again, directly from the CBO, Congressional Budget Office, they show here in 2023, we have about 100% of debt to GDP, 100% ratio of GDP growth, debt to GDP. But they're showing this on a chart, I wish I could show it to you, going straight up almost like a hockey stick. And by 2050, again, the CBO projects by 2050, we'll be at 200% debt to GDP. Well, that's not sustainable. They go on to tell us more. The Treasury goes on to tell us, they actually published in this report I'm talking about, they titled it, this was Executive Summary to the Fiscal Year for 2021, and they titled it, quote, an unsustainable fiscal path. And in this, they showed that the amount of debt held by the public is going to go up by astronomical amounts. Like I said, by the year 2045, we'd be at 200%, but they show by the year 2080, 600%? What? 600%? So we are on an unsustainable path. Let me give you a couple other data points, then we'll move on. But what else was in the report, or what else is relevant to the report, I should say, is that this is based off of the debt, right? The amount of outlay. So they're showing $700 billion in interest being owed. But again, interest rates are going up, which means they'll owe more. Now, a lot of the debt that the government has is locked in by timeline. So there's 0 to 1 year maturities, there's 1 to 3 year maturities, there's 5 year, 10 year, 20 year, 30 year maturities. So not all, just as the Fed continues to raise rates, doesn't mean all of the rate goes up, which is why the Fed is showing a $700 billion amount, even though, the Treasury is showing $700 billion owed, even while the Fed is raising rates. It's because a lot of that debt is locked in. But that's part of the problem. So what we know is that of all the U.S. government debt, we can see what the maturities are. And what we can see is that 50% of the debt, of the 31 trillion, 50% of that matures in the next 3 years and is going to have to be refinanced. Now, the Fed is telling us they're going to raise rates and leave them there. Raise rates and leave them there. Now, they're talking about maybe getting to 6%. So what does that mean for the outstanding government debt, and what should we expect? What's keeping the Treasury up at night? Remember, the Treasury, the U.S. government, is that of the $31.5 trillion of debt they owe, it's locked in on these different maturity dates. But 50% of the debt is maturing and is going to have to be refinanced in just the next 3 years. And so remember those CBO projections I was telling you, where by 2030 we're at $2 trillion a year? Well, and how grossly misstated those are, because one, the income is going to continue to go down, but also the amount of interest expense is going to go up. And so we can see 50% matures in the next 3 years, and it's going to be replaced at rates of wherever we're at, 4, 5, 6%. So how's that going to work? It's going to take that $700 billion number, and it's going to push it through the roof. We're going to go to over $1 trillion a year of just interest only. So that's where we're headed. Fun stuff. So that's why Paul Krugman is wrong. Now, if you're Social Security, or if you're on Social Security or expecting to get Social Security at one point, I have something to tell you that you may not like, and that's that it is set to start running a shortfall by the end of the decade. As a matter of fact, if the Social Security funds become insolvent and there's no change to current laws, beneficiaries would see more than a 20% reduction in benefits. So I'm not planning on getting any at all by the time I retire. And if you're on it, that's something to be paying attention to. You might start seeing a reduction there, a drawdown, which is going to be super important if you're depending on that at all. But again, they're basing all of this information on economic data. One, the amount of revenue they're going to collect. But again, if the economy continues to go downhill, then the amount of tax revenue they collect also goes downhill, which puts the deficit even higher. And we can see that the economy is seemingly barreling into a recession. No matter what they want to tell you with the data, the jobs data, the unemployment data, it's all wrong. Everything you've learned is wrong. So we can see here, if we look at some different economic indicators, we can try to find it ourselves. There's this Conference Board's leading economic indicators. It's continued its decline in January, dropping 0.3% month over month. So that's not good. We can see it's the 10th straight monthly decline in the LEI, leading economic indicator. It's the longest streak of declines since Lehman, which was 22 straight months of decline. So we're currently in the longest streak since Lehman happened. Among the leading indicators, we have deteriorating manufacturing new orders. So manufacturers aren't ordering. So manufacturing production is going down. Remember, wealth is not money. Wealth is goods and services. So when manufacturers aren't producing goods and services, that's not good. Also, leading indicators are consumers' expectations of business conditions, credit conditions, and all of that combined more than offset the supposed strength that we had in the labor markets. The Conference Board expects high inflation, rising interest rates, and contracting consumer spending to tip the U.S. economy into recession in 2023. So if that happens, tax revenues go down. It says this is on a year-over-year basis, the LEI is down 6.03%, which is close to the biggest year-over-year drop since 2008. So we're on the longest streak since we saw in 2008. We're almost to the same size of drop that we saw in 2008. It's not a good sign for GDP. And if it's not a good sign for GDP, what does that mean? That means tax revenues go down. We can also see subprime auto loan delinquencies just hit a 13-year high. All this money that got injected into the system through the COVID pandemic got, all these companies to expand very quickly, like Amazon, started building out all these new shipping centers, started hiring all these people. All these people got hired onto new jobs, and they went out and bought cars with that stimmy. But now all the layoffs are happening, and now people can't afford those cars. Now, I've been hearing stories and reading stories of all these cars at car auction lots that have never even been registered. meaning they're brand new, they're less than 1 or 2 years old, where people bought them probably on their stimmy and then never even got to the first registration where they had to pay for the tags. So that's a big one. And so we also, and now we're starting to see that the Fed might start understanding this, because the problem is that they are hell bent on getting inflation back down to this 2%. Supposedly, I don't even know where there's a story this week I saw that where did 2% come from? Supposedly, New Zealand just pulled that number out of thin air. Oh, let's go with a 2% inflation rate, and apparently that's what stuck. But the problem is as the Fed continues to try to bring inflation down, they're pushing asset prices down and home price down to make you feel poor. But as you feel poor and as you have no cap gains, the government doesn't get the funding at the same time as their spending's going up. They're already a zombie company insolvent, which means they're only even more insolvent. So the question is, or the question that I would ask myself is, what does all this mean? What does all this mean, Mark? I mean, okay, you've made a case. The economy is going into recession. The Treasury itself, per its own report, says that it's insolvent, and it's only going to become more insolvent. What does this mean? It means that money printing is inevitable. That's what this means. So what this means is that the federal government is insolvent. They're bankrupt. They haven't filed for bankruptcy, but they're insolvent. They're spending way more on just mandatory expenses than they bring in income, and at the same time, their income is going down, their expenses are going up. They're going to have to refinance all this debt at higher rates and all these things. So no government with a money printer will go bankrupt. So this means they're going to print money. So while we have all this posturing and the Fed says they want to continue to tighten the markets, they don't want to ease the markets, we know what's inevitable. And I believe the markets know what's inevitable, which is why the markets aren't going down. Jerome Powell keeps wanting the markets to go down, but they don't. I saw this article this week talking about how the Fed minutes appear to argue against what Powell was saying in the presser, and they wanted him to go back and reiterate again, but Powell declined to try to talk down financial markets, saying we're just going to have to see. Saying, look, I told them what's going to happen. Let's just leave it up to them. They're going to figure this out. But the markets don't believe what the Fed is saying. And the reason why they don't believe it is because they know what's inevitable. They know that the Treasury is going broke and they're going to have to print the money. No government with a money printer will go broke. And so while we don't know exactly what's going to happen over the next 2 to 3 months, we do know what's going to happen over the next 2 to 3 years. And what's going to happen over the next 2 to 3 years is massive amounts of money printing. The US dollar is going to have to get weaker. When the US dollar gets weaker, it will push asset prices higher. There's no other way. Now, like I said, the other way is the government goes bankrupt. But of course, as I said, no government with a money printer will go bankrupt. And so I think the chance of that happening is slim to none. Now, there are two types of defaults, of course. There's the default where I don't pay you. And there's the default where I just pay you back with a bunch of made up money that's not worth as much as what you're actually owed. So I pay you back the $1 million I owe you, but it only buys you $500,000 worth of goods today. And that's exactly what's happening. And that's where we're going. And so if you're trying to plan, what should I do with my business, my investments, et cetera, if you think long term, you know it's inevitable. The money printer will burr again. If you're just tuning in, you're listening to the Mark Moss Show. We've been talking about what the Treasury report said and the inevitability of money printing. The financial revolution is here, and we're witnessing it. And that's what I got for today. Thanks so much for listening.